Chair Gensler, I'd love you to listen to a response as well, though, from the Virtu Financial CEO, specifically about you and what he had to say in terms of what he claims is you conflating some issues when it comes to payment for order flow, and then get your response.
He's conflating the issue of payment for order flow and the inherent conflict, which has been addressed and dealt with for the last 30 years by the SEC, with order routing and price improvement. Two separate issues, and the data around price improvement is so overwhelmingly compelling. $11 billion of price improvement in 2020. $11 billion and zero commission trading in this country. Game, set, match.
Your response?
Well, let me just address. I don't think that the disclosures that are put out really address the question about whether people are getting best execution. So best execution means best execution. And so we have something in America where nearly half of the trading is going to dark pools and to the wholesalers, one of whom you were just interviewing, wholesalers that dominate and concentrate the market. And even that which is on the so-called lit markets, the New York Stock Exchange and NASDAQ, many of the trades there are not being fully displayed. So this concept of price improvement is against a measuring stick, which is a measuring stick that's not fully reflective of the market. Our consolidated tape, our national best bid, best offer, so to speak, does not reflect the half in the dark markets. It doesn't even reflect a lot that's on the exchanges. So if you or I make a trade, a market order retail trade, where does it go? 90+% chance it goes to a handful of wholesalers, one of whom you were interviewing. I would say that's a conflict. And the thing that we're trying to do is update our markets for the 2020s. They were last seriously updated in 2005. A lot's changed in those 16 years.
You know, Mr. Chairman, I want to follow up on that. This notion of payment for order flow, and I understand what the Virtu fellow said, but isn't it true that if brokerages are optimizing their digital engagement practices for their own revenue, that may not be exactly on the same page as of giving investors the best returns? So therefore, investors should know ahead of time that they may not be getting the best returns by so-called paying no commissions?
Jim, I thank you for that. You're absolutely right. So today's data analytics aren't what you and I learned in college. They're very sophisticated, and they can optimize for the trading platform or the robo-advisor to maximize their revenues and their data collection. That may well be in conflict with your investor returns when they're trying to use a behavioral prompt to get you to trade more or to move into one of their investment products. Secondly, you mentioned zero commission. Zero commission does not mean it's free to the retail public. You may not be getting best execution. And so that's what our economists, that's what we're looking at very closely to see, can we do better? And I think that we can do better than the regime that was laid out 16 years ago.
You know, when we talk about regulation exposure to a number of new platforms and technology, not just in financial services, one thing we keep coming back to is the popularity of the platforms creating friction for regulators. Is it any more difficult to regulate something that's popular, maybe because the client base does believe it is zero commission?
Well, you raise a good point. And technology has come along and changed the nature of finance. I mean, the internet came along and that changed the nature of finance as well. So these are the challenges we have. It makes it an exciting job. But at the core, what we're trying to do is get competition in the market. I mean, it's a basic thing in America. I'm deeply a markets person and believe in transparent trading and competition, order by order competing. And right now, we have large wholesalers buying a bunch of that order flow. And so that the retail public, most of your trades are going to a small handful of wholesalers. And in fact, they've publicly announced there's a high concentration amongst 2 or 3 of them. And that's not the lit markets of New York Stock Exchange or NASDAQ as we know them.